Carl.
Jim, what separates today from another garden variety growth scare, and are bonds suggesting that we're looking at a global recession?
Yeah, I think this is less about the coronavirus today, Carl. That's the catalyst, but I think this is all about the bond market, and our yield's going to break to record lows in the United States, and they already have in the 30-year. We'll see if the 10-year 136 holds, but I think that's what this is about. It's creating fear. What does the bond market know? The stock market doesn't. I would suggest that the bond market's message is not as bad as people think, because when you look at it, bond yields are back to where they were last fall in September, but credit spreads have tightened over that same period of time. I think what the message of the bond market with that combination is that yields are down because inflation is AWOL, but if it was of a growth story, you'd expect credit spreads to be blown out, and they are not doing that. What we have today is almost record low bond yields with record tight credit spreads. That's a message of inflation is down, but growth is okay. And I think that's the same message the stock market is saying, Carl. 8 of the 11 sectors are up year to date, suggesting healthy real growth. The only sectors that are down are mainly in the inflation sectors, energy and materials. And I really think the message of the stock market is inflation is low, but growth is okay. So I think it's not as detrimental of a message as people think.
All right. Market's a little challenging to put this into actionable ideas given your limited view, your limited universe. But what ideas do you draw from a day like today?
Let's see. I think core internet fundamentals seem to be largely intact. We look at the largest names that came out of the December quarter earnings. We did see a little bit of deceleration in some of the ad names like Facebook and Google. But we're going into a year, the big macro backdrop is this is a very robust year for advertising because of the elections, because of the Olympics, primarily because of those two factors. So you want names that you can buy that'll give you exposure to that at a reasonable price. And I continue to think that Facebook and Google offer you that. You're paying 22, 23 times earnings for names that are growing, that are growing earnings 20%, plus clip. I think valuation's highly attractive. And if you have a macro catalyst like a big advertising year like this is, you want to own these stocks. You want to be long them.
Mark, I want to come at it from the other side, though, which is a couple of surprises this week. Zillow and Dropbox. Is there anything to extrapolate from those? I mean, they're smaller stocks, market cap around $10 billion for Dropbox and a little bit more for Zillow, but they kind of outperformed in a way that saw them rise more than 20% on the week.
Yeah, Zillow is, we're on the sidelines on Zillow. It's had a wonderful move off the bottom. We completely missed it. It's doubled. I find this very interesting. Their core premier agent kind of advertising business has now started to positively inflect. It's going to have accelerating revenue growth and margin expansion. That always bodes well for stocks. There's still this big bet, however, that the company's making on the iBuyer market. We still haven't seen proof of profitability, but they're showing scale, and you can't be profitable unless you scale. So at least they got the first part of the thesis right. So if they can translate that into some sort of movement towards profitability in the iBuyer market, there's still substantial upside in the stock. We're just waiting for that proof point. Dropbox is a little bit of a different story. When they start announcing share buybacks, they've got the cash to do that. That's usually, and they show more movement on the free cash flow line. Like that's starting to really prove out as a relatively modest grower, but high potential free cash flow generating company. That's an asset you want to be long.
Jim, I want to go back to your points about inflation being AWOL right now. I wonder if that is going to continue to be the case. I mean, we've got air freight rates poised for a major spike in the Asia-Pacific region right now, given what's going on with supply chains there. You've got reports that U.S. manufacturers are trying to source from places other than China, and that's already leading to increases in things like components from U.S. companies and the like. Are we potentially at risk of a big spike in inflation the longer this coronavirus situation persists?
I do think, Morgan, that we're going to have inflation numbers start to rise in the balance of this year. I do think that growth is pretty good. I know we're going to take a one-time shot here from the coronavirus. Hopefully, it's not longer than that, and it'll put a dent in first quarter global growth, maybe second quarter, but I think we'll get that back later in the year. And if we do, growth in the U.S. is really strong. We're at 3.5% unemployment. I think that's going to eventually, if there's acceleration and we get to the other side of the coronavirus, people look at a global recovery, I think inflation is going to become an issue in a hurry. You know, even in the commodity market, Morgan, they're telling the same message. Most commodity prices are down except for one notable area, and that's the industrial commodity prices. The CRB, Raw Industrial Index, that's the stuff that's most sensitive to economic growth, has risen 5 to 6% off its December lows, its biggest upside move since it peaked in early 2018. So commodity market is also suggesting that inflation is weak, but real growth is accelerating. And I think if real growth does come through, we're going to have all commodities start to rise, and you're going to see wage inflation and core consumer inflation, I think, continue to climb higher. So while we got this story at the moment of lack of inflation, we might be in a very different situation by year end.
Yeah, so given the fact that we've seen this flight to safe havens, we've seen this risk-off sentiment in the market that's playing out again today, then, Jim, you sound like a man who is risk-on. Where would you be putting your money? Where are you putting your money?
Well, I think we're going to have some of both leadership. It's not going to be value or growth the rest of this year. I think growth is going to continue to outperform, and I would continue to own a core holding. I agree with Mark. I think that the tech stocks, you know, they're getting a little overvalued, but they're also following fundamentals. Real sales growth of S&P 500 companies continues to outperform the overall market. Real sales growth of S&P 600 tech companies also are outperforming the overall market, and those stocks are following the relative fundamental performance up. I think that's going to continue, but I also think that if we agree at some point as a consensus that economic growth is having another upward tilt, kind of like we did in 17, 18, then I think you're going to see some of the cyclical sectors pick up as well, a recovery in some of the commodity stocks, a recovery in industrials, and I think emerging markets also come back. So I would sprinkle my bets beyond just growth and keep my growth bet as well.